guys, to another MBS Highway live webinar. If you've watched our updates, you have heard of our special guest. He is the chief economist at CoreLogic, which is America's largest provider of advanced property and ownership information, analytics, and data-enabled services. Before CoreLogic, he served as the vice president and chief economist at Freddie Mac. He's also been an economist with the board of governors of the Federal Reserve System in the mortgage and consumer finance section. Welcome, Dr. Frank Nothaft.
Thanks so much, Megan. It's a real pleasure to be here with you and with Barry Habib. So good to see you again, Barry.
It's good to see you again, Frank. For those of you that don't know, Frank and I are good friends. Goes back a very long time, Frank. Probably close to 20 years that we've been friends. So it's
close to it. Yep, absolutely.
Yeah. It's really a pleasure to be with you once again.
Same here, Barry. You're looking great too. Looks like the pandemic. You got through the pandemic just fine.
Thank you.
Now, I think what everyone is really excited about, and what I'd like to start off with is, at MBS Highway, we just came out with our 2022 forecast for the housing market. And I think everyone would love to hear your take on what you think is going to happen, Frank.
Sure. Yeah. Well, I think we're going to see a pretty good housing market here in 2022. We still see mortgage rates, even though they're up a half a percentage point over the last month, we still see them actually quite low. So the average mortgage rate is running about 3.6%, 3.7% for 30-year fixed rate right now. And that's certainly up from what we just saw a month ago or even last year, but it's still low historically. And I'll tell you what, one thing we did, Megan, we took a look at what the average 30-year fixed rate mortgage rate was for the decade before the pandemic. So from 2010 to 2019, that period. And over that 10 years, the average mortgage rate was 4.1%. 4.1%. So we're still well below that. And at 3.7, we're pretty much below any rate that we saw pre-pandemic. So rates are up, I know, but they're still pretty low. And I think with all the concerns about the Fed pushing up interest rates and rates being higher in the future, that's going to attract some prospective home buyers who've been maybe sitting on the sidelines to come into the marketplace now to buy before mortgage rates go up even higher. So I think the spring home buying season will actually turn out to be pretty good. What we do need is more inventory. We've got an inventory shortage in the marketplace. If we just had more homes to sell, I'm sure we could sell more today. So I think the housing market as a whole will do well, but we can't expect double-digit home price growth year after year after year, and that's what we've had. Over the last year, we've had close to 20% growth. Some markets up 30% or more over the last year. That can't be sustained. So we do expect to see some slowdown in home price growth over the course of the year, not immediately, but as we get into 2022, we'll see some slower home price growth. We'll also see a lot less refinance. So I think home purchase originations going to be good. It's going to be up this year. Refi way down. So, and the drop in refi is because of the increase in rates. So a lot less refi, probably refi down probably more than 50% compared to last year. And a really interesting development will be the shift in the composition of refinance in 2022. So it's not going to go away. There's still going to be plenty of people refinancing, even though down more than 50% from last year. But what the shift in composition will look like is a lot more cash out. A lot more cash out refinance compared to what we saw the last 2 years. And that's in part homeowners taking advantage of the fact that home prices are up, home equity is way up. They're going to tap into that home equity, use some of those funds to consolidate other debts, and importantly, make home improvements. And we've already seen home improvement spending last year at a record level. I expect it to be even higher this year, another record-setting year for home improvement expenditures. That's the additions, alterations, renovations that people are making to their homes.
And, speaking of kind of these supply chain issues, I know that we need inventory. Do you see that getting alleviated at all this year?
Well, I do. I hope so, but it's not going to be right away. We've already seen lumber prices spike once again. And with the increased lumber prices that we've seen recently compared to what prices were, 12, 18 months ago, that adds about $30,000 to the price tag of a newly built home. So, that's making it just really a challenge for new home buyers who are in the market looking to buy because prices are up significantly. And what we're seeing also with new construction is that the time it takes to go from a permit to a start and ultimately to a completion, that's longer, that's lengthened. Time is money too. So, because of these delays in getting the materials, getting all the appliances, getting everything you need to complete the house, that's lengthening that time period. Material costs are up, labor costs are up, land costs are up, and it's taken longer to go from permit all the way to completion. Time is money too. So costs are up across the board, and that's increasing the price tag on all of the new homes that are coming out in the market. I do think we're going to see an increase in single family construction and completions in 2022. So up from last year's level, which is good because we need more homes, we need more inventory. So I do expect that'll happen, but the homes aren't going to come cheap. They're going to come with higher prices because of these supply side disruptions.
So, Frank, you came out with an individual forecast recently, and I was happy to see it be different than the CoreLogic official forecast. So, all along I thought that maybe you might have seen things a little bit differently, but if I'm not mistaken, you were in that kind of 6% range for 2022 on overall appreciation. Is that right?
On home price growth.
Yes.
Actually, if you don't mind, let me share a chart because my forecast is the same as the CoreLogic forecast, so it's really not different. It depends how you view the numbers, and let me explain what I mean by that. So early here in 2022, because inventory is low, mortgage rates are still fairly low, I do expect to continue to see double-digit home price growth in our national index and in many markets around the country. So we start the year with double-digit home price growth, probably through the spring, but price growth slows as measured over a 12-month basis. So by the time we get to the end of the year, we're back in the single digits, and maybe by December, we're in the low single digits. So what we put out in the press release is, gosh, look at over the next 12 months, December 2021 to December 2022, 3.5% home price growth. However, if you average it over the 12 months of the year, it's a lot stronger because we're starting the year with double-digit home price growth. So when you average it over the 12 months of the year, look at the average price in 2022 compared to the average price in 2021, you get 9.6%, almost double-digit home price growth in 2022. And that's because we start the year very strong with home price growth. It's the same projection, it's just viewed a little differently. And let me share a chart that'll summarize that. Just give me a moment here, Barry and Megan, just give me a moment. Let's see. Can you see this one?
Yeah.
Yes, we do.
Bars. So this kind of summarizes what we've seen in home price growth and what we're forecasting. And the blue bars are the 12-month projections and the 12-month history measured December to December. Just that 1 month, December to December last year, December to December next year, December to December 2 years from now. The red bars are the average price growth for the full 12-month calendar year, averaged over the 12 months. So if you look at the second red bar, the second blue bar, that's what we saw during 2021. If we look at the 12 months of 2021 to an average and compare with the 12 months of 2020, home prices were up 15.0%. That's the second red bar. If we measure December to December, just looking at December, not 12 months, just this December to December, prices were up 18.5%, which, by the way, is the biggest 12-month price growth we have seen in our national index in the 45 years that CoreLogic has the history on the price index. This most recent 12 months from December 2020 to December 2021, highest ever in 45 years. Whew. Now, looking at the projection, if we again do annual average 2022 versus annual average 2021, that's the third red bar, that's the 9.6%. Because we start the year really strong with double-digit home price growth, but it moderates. And by the end of the year, I think mortgage rates are higher. That's going to reduce some demand. We'll probably see inventory for sale linger longer on the market. Price growth will slow. And so the third blue bar, the one that says 3.5%, that's looking from December 2021 to December 2022. So it's the same forecast, it's just viewed a little differently. And then as you see,
Frank, I gotta stop you there because I just want to try and get a clarification here.
Sure.
Let's assume at the end of 2021, there's a home that's valued at $100,000. So in 2022, the end of 2022, is it worth 109,000 or is it worth 103,000?
So if at December 2021, it's $100,000, which I'd like to buy that home. I think that's a very affordable home. but if you could find a home that was priced at $100,000,
I'm just using it as a point of reference rather than just an easy number. You know,
easy number. I
pick a million, pick what, you know. But I'm just trying to use a round number here.
And $1 million, that's more like what the prices are going for in lots of communities around the country, even here in Northern Virginia where I live. So if it's $100,000 in December 2021, it'll be what our projection is. It should be $103,500 in December of 2022, 3.5% increase from the December 2021 value. Because in December 2021, that home price has already gone up a lot over the course of 2021 because of the really strong price growth, because of the really strong housing demand.
I get that, but then where does the 9.6% tie in?
Well, annual average, because that home that's $100,000 in December 2021, if you looked at it, you know, earlier in 2021, it was cheaper. Maybe it was $95,000. So if you compare what the average price for that home that you were looking at in December 2021, what the average price was back in January of 2021, February 2021, March 2021, it was lower. So if you take that average for the year and compare it to the average for 2022, you'll actually see prices are up 9.6%.
I understand what you're saying, but you know, I think for most of us, what we're accustomed to is, you know, just year-over-year price growth. If you're taking from, you know, if you're choosing at the end of the year, like what would appreciation be forecasted for 2022? What you're saying is the gain that you'd see in 2022, the forecast is 3.5%.
Over the 12 months.
Yes.
Because prices are very, very high in December of 2021. Remember that, right? They're already up in December 2021.
But if you're looking at it as a stock price, you know, if you pick, okay, what's Apple's stock at January 1st and what's Apple's stock December 31st of 2022? If we were talking about the stock of Apple and the way you'd measure pretty much any financial institution would measure a stock, it would be a 3.5% gain.
Right, over the next 12 months.
All right. That just makes it clear. I just want to make sure we're talking about the same things. Okay, thank you.
Yeah.
And I'm seeing a lot of folks also having similar questions that they're bringing up in the chat box. So that's I'm trying to help them also digest this.
Oh, absolutely, yeah. And it's tricky because, you know, when you see different forecasts, people are measuring prices different ways. Some of them are doing annual average over annual average. Some are doing 4 quarters. Some are doing 12 months. So 12 months, the 12-month growth, 3.5% is what we're projecting.
That's the typical way of doing. I think that's what most people are accustomed to. That's, you know, that's the way you would kind of any market forecast in equities would be viewed that way. So I understand that there's different methodologies here, but I was just trying to clarify for everybody listening in so that they kind of get an apples to apples comparison.
Hey, no, I get it. No, absolutely.
So Frank, so you're at 3.5% is what CoreLogic's expecting. So no, listen, we're a lot higher than that. You know, we're at 8.5% is our forecast for the year. And the methodologies that we use have a lot to do with the supply and demand shortage that's out there. And I know that you've cited that. So wouldn't you guys think that that drastically short level of demand of supply needed to meet the demand would give prices a little bit more of a move higher, especially if you think we're going to be moving up significantly higher towards the first quarter that we're in this year, as in also into the spring buying season? That would almost require prices to, in the second half of the year, decline.
No, we don't have prices declining. But let me ask you this, Barry, where do you see mortgage rates by the end of this year?
So our view in mortgage rates, and we did call this in our forecast in December, we said, we've said the first part of the year, they're going to 3 3/4. It's documented. We said that we hit that on the head. There actually might be a little higher than that, depending on where you look. The MBA this morning said 4.05%. So it depends. Again, measuring sticks are different, and you know, the way it's viewed is differently. But we believe that inflation has been a big driver of this, and inflation, we see that peaking next month. We think that's the apex, and the numbers should come down on a year-over-year basis because of very tough comparisons. But in addition to that, we think that the Fed rate hikes will probably slow inflation. That historically, as you know, tends to help mortgage rates. The wild card for us that makes it so hard is the balance sheet runoff. So from our perspective, it's a very difficult way to forecast. If you ask me, balance sheet runoff aside, we'd say mortgage rates maybe below 3% at the end of the year. That's where we see it. But the balance sheet runoff is such a wild card, because if the balance sheet starts to run off and it's at a reasonable clip, we could probably absorb that because there's less supply coming to market. As you cited, refinances are down. So we think that that's okay. But as some of the Fed members have said, we need to be aggressive in the runoff or actually outright selling of mortgage-backed securities. That would be problematic, you know, for the environment to absorb that much without seeing rates move higher. That's difficult. That's what makes this a very tricky scenario to try and view and forecast. There's so many, you know, it's hard enough with one variable. You're throwing in 3 variables here, and it becomes a real tough guessing game. Now, over time, I think rates come lower. I think we're headed for a recession. I think 2023 probably, it's always hard to guess the timing, is a recessionary period, because every time in history that the Fed, as you know, has tried to fight inflation, we end up in a recession. And the yield curve is already flattened from a year ago, 160 bips to recently 40 bips. I think the yield curve, if the Fed does bump 50 or get us 100 basis points in the first half of the year, increase in the Fed funds rate, you probably push the yield curve to an inversion, unless you really aggressively let the balance sheet run off. But then the stock market probably doesn't like that. And we know the Fed, we know they talk tough, but as soon as the stock market throws a fit, they're afraid of their own shadow. So I know it's a long way to answer your question, Frank, so I'm sorry, but I think rates should move lower, but it really highly depends on the aggressive nature of the balance sheet runoff.
Can we explain in depth a little bit before we get to Frank's thoughts on this too? We just have some questions on what exactly the runoff is.
So the Fed is holding a little beneath $9 trillion, which I know we get immune to trillion, but is an enormous amount of money in mortgage-backed securities and treasuries. And under normal circumstances, look, imagine if you're listening to this, you're a bank and you loan me money. As if I and you say, okay, I'm loaning Frank money, I'm loaning Megan money, I'm loaning Barry money. And this is how much I have in loans that I've put out there. And if Megan refinances her home and pays what she owes you, you normally would have a lower balance that you have. Frank sells his home. What he pays you, you would reduce that. And if I'm making my mortgage payments to you, a portion of my mortgage payment is principal, which should reduce the balance owed to you. So that's a normal circumstance. But what the Fed, that would be called balance sheet runoff. But what's happening is the Fed is taking that differential, and it's a huge amount of money. It's currently $70 billion a month that would normally come off. They're taking that and they're repurchasing mortgage-backed securities with it. So that's keeping rates a lot lower. Like in this inflationary environment where you have 7.5% as measured by CPI headline and 6% core, mortgage rates should not be this low. Mortgage rates should have gone up a lot higher than they are. They shouldn't be 3.5 or 3.75 or 4. They should be significantly higher. But the Fed's aggressive buying because of the reinvestment from their balance sheet is suppressing mortgage rates. So if they start to let the balance sheet run off, which they aren't doing now, they're still actually buying mortgage bonds, which is crazy. If they start to allow the balance sheet to run off in an aggressive manner, that's going to cause problems for the mortgage-backed security market, or interest rates will probably be pushed a little bit higher. Now, that's going to be counterbalanced if inflation comes down. So you got these opposing forces, which makes it really hard.
Frank, sorry to cut you off, but I think everyone is very curious about your take on this.
Oh, sure. Hey, and I agree with Barry. This is a really difficult period to really forecast because it really depends so much on reading the tea leaves about what the Fed's going to be doing. And I tell you, Barry, I'm personally really happy there are meteorologists, because meteorologists make economic forecasts look good, and so it's a really hard market. I'm more pessimistic though than you are in terms of the inflation outlook and mortgage rates. So that's why I asked you about mortgage rates. I would agree with you if we're seeing the peak in mortgage rates about now, and mortgage rates maybe go a little bit lower later this year. Gosh, I think that's going to really juice up demand, and we're going to see much stronger home price growth. So you and I are in alignment on that. I'm more pessimistic though. My view is probably a little bit closer to what the MBA outlook is. I think mortgage rates, yeah, they're up. They're already up 0.5 percentage point over the last month. I think there's going to be upward pressure later this year. We'll probably see 30-year fixed rate mortgage rates, get up to 3.8, 3.9, possibly even hit 4% by the end of this year. And that's kind of what's behind our view that home price growth still continues. We don't have any home price declines, but doesn't continue at 8%, through the end of 2022. We do have it moderating to about 3.5% by the end of this year. So it's differences in our view about what will happen with mortgage rates that I think account for that differences in home prices. I agree. If mortgage rates go down from here, yeah, we're going to see a lot stronger home price growth.
I'm curious your thoughts on the Fed and what you think happens with inflation.
Well, the next Fed meeting is about a month from now, mid-March, and I do expect we're going to hear from them that they will increase the Fed funds target by 25 basis points. There's a lot of chatter out there that maybe they're going to do a big move, 50 basis points. Yeah, it's possible. I don't think so. I think they will take a step and increase the Fed funds target 25 basis points and continue to do so incrementally over the course of the year. So once a quarter, I think they're going to increase the Fed funds target till they finally get comfortable that inflation is turning around and coming down. So 125 basis point increase in March, another one in June. I expect another one in September, and probably one more in December to close out the year. So we could see a 100 basis point increase in the Fed funds target over the course of this coming year. Big question, as you put it, Barry, you summed it up really well. What's the Fed going to do with its portfolio of MBS? They've already announced that they are tapering in terms of not growing the portfolio further after March, but how quickly will they allow it to run off or decline? And will they be much more aggressive in terms of selling it off? And that's the big question. I am a lot more concerned about inflation too. And I'll tell you why. We haven't yet talked about single family rent, but rent is up a lot on single family homes, multifamily apartments. You look at either the CoreLogic single family rent index or some of the metrics that are out there on multifamily rent. double-digit rent growth over the last year. We measured 12% rise in rent on single-family rentals over the 12 months through December 2021. And apartment rent is also up something like 12 to 14% over that same period. Now, you look at rent in the inflation metrics, like the consumer price index that you mentioned, Barry. Rent in the consumer price index through December was up less than 4%. And, you kind of scratch your head. Well, market rents are up 12% plus, at least 12%. In the consumer price index, rent is only up 4%. How's that? And the difference is that what the government does in measuring inflation, rent inflation, is that they look at the average rent on the entire rental housing stock. And because tenants typically have a 12-month lease, that means 1/12 of this jump in market rents is captured each month. So my concern is that over the next several months, we're going to see rent as measured in the consumer price index really start to rise because market rents are up 12% or more across the country. And so the rent component of CPI is going to be up, well above what it was at the end of 2021 and be peaking perhaps not till the end of this year. The reason that's important is that people spend a lot of money on shelter, on rent. Even for homeowners, what the government does is that they impute the equivalent rent amount for a homeowner into the inflation metrics. So when you look at all this, rent represents 30% of the consumer price index. Rent has a 30% weight in the consumer price index.
I think it's 20. I think it's the most recent is 24%, Frank. The most recent number, which I just looked at this. I know this because we just looked at this in the last year. It's 24% is what the rental weighting is.
So it's still a big weight.
Yes.
And core CPI, which you mentioned as well, has even a bigger weight. Rent is closer to 40% of core CPI. So if they haven't fully incorporated rent inflation in the consumer price index yet, because they're looking at the average for the entire rental housing stock, and it gets incorporated over the next several months, that's going to put a lot of upward pressure on measured inflation. So even if all the supply disruptions go away and the Fed gets a lot of good news on energy prices, gas prices start to ameliorate and come down, you still got rent pushing up on the inflation numbers. So I'm a bit more pessimistic. I don't think we're going to continue to see 7.5%, 8% inflation numbers. I think they'll start to come down, but they're not going to get down to the Fed's target of 2% inflation. Not this year, maybe not even next year. It's going to take longer. And that's why I think we're going to see some continued push by the Fed to increase interest rates.
So yeah, I totally understand that. I completely see your points on that. They're really good. But what about the fact that every time the Fed has tried to fight inflation, which it seems like they're doing, it's so funny, Frank, because you mentioned earlier they're still buying mortgage-backed securities, right? So it's like you're an arsonist that's going to turn firefighter, or it's like me saying I want to take off a few pounds, but I'm going to start that in like a month or so, and until then I'm going to have cake and candy and all that crap I can eat. It just doesn't make a lot of sense to normalize people like those of us listening on the call, as to what the Fed is. But when we examine the historical ability of the Fed to fight inflation, they have not been able to elude a recession. And do you think we elude that this time? And if we do, then we know during recessionary periods, rates come way down. So how do you feel about those things? Again, these are hard things for us to kind of forecast and think about because there's so many moving pieces here. So just what are your thoughts about that overall?
Yeah, well, I do think we're going to continue to see pretty strong economic growth this year. The big question mark, as you say, is 2023 and beyond. And if I understand you right, Barry, you've got some weakness, maybe a recession in 2023. It's possible. I think there's enough momentum, enough inertia in the economy that we can probably forestall that a little bit longer, hopefully till 2024. But you can't rule it out. You can't outlaw recessions. Recessions will happen from time to time. I don't think we're going to have that in the next year or two. But I do think 2024, yeah, that's a real possibility, especially if the Fed has to jack up interest rates really high in order to combat inflation. Depends how serious they are about getting back to this 2% inflation target. We're well above that at the moment.
Frank, do you think the Fed has enough backbone to stay the course? We know that Jerome Powell is no Paul Volcker, but do you, and he's almost repeated the acts of Arthur Burns. Do you think that the Fed will have the backbone to stay the course if the equity market, which already is, if by many metrics, a very expensive stock market, starts to show signs of throwing a fit? Will the Fed take their hands off the chokehold of trying to fight inflation and ease off, and then we see a whole different environment? What are your thoughts on the Fed's ability to stay the course? This Fed.
It's a great question. So my hope, my belief is that the Fed will be serious about inflation. The Fed has worked so hard over the last 40 years to get the inflation genie back into the bottle and keep it in the bottle and maintain 2% annual inflation, which is roughly, we've been running about that, a little bit below that for the last 20 years. Hey, that's great. And so they've worked so hard to do that. And once inflation is heating up and running above that and starts to affect inflationary expectations in the mindset of consumers, workers, capital market investors, it's really hard to pull back those expectations, get that inflation genie back into the bottle without causing a recession. So that is the big challenge. That's one reason you've got Chair Powell and a lot of his colleagues kind of like jawboning or talking in the market saying, we are serious about this. We've got an eye on inflation now. We've achieved our objectives in terms of maximizing employment with price stability, blah, blah, blah. So, they are trying to reinforce inflation expectations that, yes, the Fed is serious about keeping 2% inflation longer term. Do people believe it? That's the big question. So I'll tell you one of the things I look at. I look at this survey that the Federal Reserve Bank of New York does to survey consumer expectations. Kind of really interesting survey. They've been doing it for about 9 years now. They do it every month. And one of the questions they ask consumers is, well, what do you think inflation is going to be the next 3 years or so? And over the last couple of months, it's running at the highest level since the Fed started this survey 9 years ago. It's running something like about 4% as the average inflation over the next 3 years. That's the people at the Fed really got to be taking notice of that, because they realize that could imply that, gosh, inflationary expectations are no longer anchored at 2% per year. Maybe they're starting to go up. And if the Fed feels that there's risk of expectations no longer anchored at 2% longer term, they're actually going to take much more aggressive action in terms of fighting inflation in the next few months.
Well, what do you think that action that they take, and this is the real key here, is by way of rate hikes or by way of balance sheet runoff? Now, the thing is that what will fight inflation more? So that here, I'm a Fed member, right? And I'm saying, okay, well, I know if the yield, I start hiking short-term rates, the Fed funds rate, that will probably slow things down and fight inflation. But that pushes the short end of the curve up. And if we go by historical, the longer end of the curve likes that I'm fighting inflation. So longer term rates, historical, tend to come down during these periods, right? That pushes the yield curve to an inversion, already just a 40 basis point spread. And as a Fed member, I'm not saying I love that, because the stock market doesn't like that, because that signals that there's an impending recession on the horizon. So do I then crank up the balance sheet runoff, which pushes longer term yields higher? But then does that really accelerate the slowdown in the economy? Because now I'm fighting with two fists, no gloves on. I'm hiking rates. I'm allowing balance sheet runoff. That really tightens monetary policy. And when the Fed historically has tried to pull two levers at the same time, like in 2018, that's a disastrous combination. Do they make the same mistake they made in 2018?
I tell you, listening to some of the remarks that Chair Powell has said recently, I think he's feeling a little bit of the pushback on some of the heat from appearing to favor one sector or one industry. And the heat he's getting is that, hey, why are you buying all those mortgage-backed securities? Why are you helping to keep mortgage rates as low as they are? Why are you favoring that sector of the economy rather than other sectors? Right? The Fed shouldn't be choosing winners or losers in terms of, industries. Fine for you to buy, U.S. Treasury securities, because that helps to keep long-term yields low, especially for Treasury bonds, and will benefit other industries equally. But why are you buying mortgage-backed securities in particular? So it's clear he's been feeling some of the heat and pushback on that, and as a consequence, that's why they may actually, make the decision, if need be, to sell off some mortgage-backed securities. I don't think they're going to do that at the next meeting in March. I think in March, what they're going to do is increase the Fed funds target, and they'll leave the window open. They'll say, gee, we're looking at this. We're thinking, we're going to see how the economy responds. They're going to allow the MBS in their portfolio perhaps to run off a little bit, but they're not going to aggressively start selling, I don't believe. But they'll keep that option on the table as something they could do if need be, if they find that inflation and inflationary expectations are continuing to rise.
Yeah, the comparisons that we're going to be meeting from last year, they were so high a year ago, starting March, April, May, that I think just a good probability we'll see an ease based upon that. I hear what you're saying is that there's still going to be inflationary pressures, but based on a comparative basis, we could see a little bit of relief there. And yeah, if we do the quick math, as those rents go up, that's probably going to add 0.1% each month on that CPI reading, right? Because when you think about, what it is on the course of the year, if we get from, let's just say 4 to a 10% rise, I'm just picking a number here. And it's 25% of CPI's headline. That's 1.5% at the end of the year. You could see, so roughly 0.1% per month of upside pressure. But I think the comparisons will help us. So these are all such hard things, Frank, to kind of figure out. Again, there's so many moving parts. But let's get back to housing for a minute, because this is look, rates are rates, and we can do cash out refis. There's equity. People are going to manage, but our customers that are out there trying to buy a home, they need our advice as to, is this a good opportunity to purchase a home? And look, whether it goes up 3.5%, whether it goes up to our forecast of 8.5%, whatever it is, right? The bottom line here is we don't see the talk of this housing bubble coming to fruition that everybody seems to be, in the media, seems to be trying to push the idea that home prices are doomed just because they're up. They have to come down. They're unaffordable. It's not without its challenges, but your overall thoughts on the housing market, I'd like to get a little bit more from you, as opposed to either renting, or do you see this bubble situation occurring? What are your overall feelings on the housing market?
It's a great topic, Barry. And I don't see a bubble forming right now. And there are two really big differences in the market, at least two big differences in the market today compared to 2005 and 2006. One difference is on the housing side. The second difference is on the mortgage side. On the housing side, today, we have an underbuilt housing market. Vacancy rates are low and falling. Back in 2006, vacancy rates were high and rising. The 2006 market was overbuilt. So that's a huge difference right there. If you have an underbuilt housing market like we have today, it makes it really hard for prices to fall broad-based because there's not enough homes on the market. And that's why we're seeing prices up record level. And that's why we're seeing rents growing at a double-digit level. The second difference is on the mortgage side. So today we have a very thoughtful, precise underwriting of mortgages, the quality of the product being manufactured in the origination process, very high quality, not like 2005 and 2006, as you recall. We had broad-based availability of subprime mortgages and Alt A, which was at the time also derogatorily referred to as liar loans, because you could make up any type of income, or whether you had a job or not wasn't verified. So very different situation. More than 1/3 of the mortgages made in 2006 were Alt A or liar loans or subprime. Those are essentially gone from the marketplace today. Pretty much everything is fully documented. So it's a very different marketplace, both in terms of the housing market and the mortgage market. And that makes me feel pretty secure that we're not going to see a broad-based drop in home prices. In fact, our forecast is home prices continue to rise. International index and in most communities, that doesn't mean they rise everywhere, because there are risks. And even when nationally home prices are rising, you generally always find communities, pockets where home prices are soft and falling because of something that happened to the local market. Maybe the local economy lost a lot of jobs because they're subject to an industry that's not doing well, or maybe they got smacked by a natural hazard. And so situations like that, sure, yeah, we can see price declines. That definitely happens. We've seen some markets with price declines even in the last year, even though we've seen this record 18.5% 12-month growth in the National Home Price Index. There's still some communities, not many, but some that have actually had price declines. So I don't see a broad-based price decline. It's not in our forecast.
Yeah, first of all, that makes a lot of sense. We agree completely. We feel the exact same way. We just, we look at the amount of units for a couple of things, just statistically, the latest for existing home sales, 910,000 units available for sale. That is the lowest that I can recall. You go back to 2007, it was 3.7 million units for sale. And today we have about 12 million more households competing for roughly 3 million fewer units. It makes it hard to imagine a bubble. And then the other one we hear all the time is affordability. From 2006, incomes are up 55%. And that makes a big difference because you're making more money in the household. And then when you take a look at the interest rate environment, it was about 7% in 2006. Today, pick a number. I know a lot of people saying that they're out there right around 4% right now. So whatever, it's almost half of what it was back then, right? So those things make a big difference in affordability. So we're very bullish on the housing market. We're not saying it's without its challenges, without places, as you had perfectly said earlier, that are going to be different than the national average, either higher or lower. But we're still very, very strong on that. And then you look at the alternatives, Frank. So what's one alternative? Well, I'll live with mom and dad. I'm not even going to have to try and explain why that might not be your best choice. Okay. Then there's renting. And you mentioned it earlier, Frank, that's no picnic either. New rents, according to Apartment List, up 12%. And then in the great reports that you do, and sort of a blend of that for single family and condos, up roughly 12%. These are big numbers, but with a purchase, at least that payment stays somewhat stable. If it's a fixed rate, your taxes can change, but somewhat stable into the future. But renewal rents are going up. I mean, take your pick. It's again, another hard metric to put a definitive number on, but somewhere between 5 and 8%, depending on the marketplace. And you get hit with that year over year. So the differential, and what's the crazy thing that no one thinks about or talks about on a purchase, and the media never mentions this, is that a portion of your mortgage payment's your own money. So there's an enormous discount that you get in comparing your mortgage payment, because the principal portion that amortizes, that's literally your own money. You're just taking it. It's like you're putting it in a separate savings account. It's your own money, but nobody takes that into consideration. So to us, it seems like when you look at the overall housing environment, the increasing demand, the tough supply, you talked about it earlier, for a builder to put new supply on the market, right? Let's think about it. You've got chips, which are needed today in everything, right? You mentioned it's appliances, computers are needed to build a home today. Materials are in tight supply, labor's in tight supply. So these are things that are going to make beefing up the housing stock happen over time, but it isn't going to be this ramp up that's going to be just, oh, boom, it's going to happen. It's going to take a while to try and meet the demand that's out there. And anytime you have more dollars chasing fewer product, prices are typically well supported.
And speaking of kind of catching up to that, I'm curious as to when you guys think that we will have enough inventory to catch up with demand.
Ooh, well, I tell you, that's one reason we're forecasting an increase in single family starts here in 2022. Even though mortgage rates are up a little bit, we have this underbuilt housing market. And one way to address this is you got to build more. You got to build more. You got to build single family. You got to build multifamily. So we do have starts up in 2022, but it's going to take time. It's going to take time to catch up to the shortfall that's out there. And there are different estimates of how much of a shortfall it is. Is it 1 million units? Is it 4 million units? Whatever. But we do have a shortfall, and vacancy rates are extraordinarily low. And it will take time to build enough homes to make sure that we've got enough inventory out there for all the families who are looking for homes.
Yeah, Megan, that's a great question. And Frank, I think you answered it as good as you could potentially answer it. It's going to take a while. How much is anybody's guess? Because again, Megan, those moving targets are, what does demand look like with regards to interest rates? If interest rates do get out of hand and you start to see a 5.5% 30-year fixed rate, well, that's going to do something to the demand equation. Even though rents aren't a great option, people might not have the choice. So right now, what you have, and that's the big difference that people have to understand right now, is that if you're in a position that you can choose to buy or rent, the smart choice should be to buy, because tomorrow, if the Fed screws this up, you may not have the choice to buy or rent. You may be forced to rent. And that's a big, big, big difference. So you may want to take that opportunity as a buyer today that you have, even if the conditions aren't as good as they were.
Yeah, it's good advice, Barry, and I agree. And I think that's what we're beginning to see. And we're going to see some prospective home buyers who are kind of sitting on the fence, and not sure whether they wanted to jump in quite yet. But realizing that, gosh, mortgage rates, they may very well be higher. Home prices do seem to be going up even further. Better to be in the market now in the spring of 2022 than to wait for next year, where mortgage rates could be higher, home prices will, I think, certainly be higher. And if you've waited another year, well, gosh, you're probably paying another 5, 8, 10% in increase in rent on the home that you've got to lease for one more year. So it's better to, I think, for a lot of prospective home buyers, it's better to be in the market now.
Yeah, and I just saw it come across. Somebody asked a really good question. How do we get to a point of such a shortage? Well, there's a lot of reasons, obviously, but if you just keep it to just a basic one, look, there's regulation, the land is at a premium. There's many, many reasons. Expensive materials cause prices to go higher. But if we think about at its core, supply and demand, builders haven't been great at looking at demographics. So if we go all the way back to 2006, if you looked at the first-time home buyer and household formations, I think Zillow gives us the median age of a first-time home buyer is 33. That brings us back to 1973. Those people born in 73 are your median age first-time home buyers in 2006. Well, the birth rates dropped precipitously in 73. Abortions were legalized back then. So we had a big drop in birth rates. So you can expect the amount of people that would be median home age first-time home buyers in 2006 would be less, and it was. But I guess builders didn't look at that data because, as you know, Frank, builders built more homes than they ever had in a year. In that year, well, they built just about 2 million homes. And the same thing in 2007 and 2008. By then, we're in a full-blown housing bubble. That changed the way homes on spec got financed and things of that nature, making it more difficult to ramp up as banks got burned. Remember, everybody else fights the last war. So now, as we're in this scenario, when you look at the same demographic chart of births, what you see is birth rates doing this. And by the way, if you take 33 years before this, today's first-time home buyer was born in 88. So in 2022, you will see more people coming to be first-time home buyers than in 2021. Next year, even more, and even more. So this continues for a few years when you look at birth rates from 33 years ago. It's tough for builders to keep up because they're so far behind the 8 ball now. And now after COVID, it really exacerbated the situation. So just trying to answer your question, how we got into such a shortfall.
No, it's a good point. And I tell you, demography is just so important. And right now is providing a big tailwind supporting housing demand. So if we look at just the millennial cohort, so now the oldest millennials are 40, the youngest millennials are in their mid-late 20s. But if you look at that millennial cohort as a whole, the peak in terms of numbers is right around age 31, 32. That's where we see the largest number of millennials. Well, that's also the median age of a first-time home buyer. So they've been in the market, they've been renting for a few years, and they've got an eye now toward transitioning to home ownership. And that number, that's the peak of the millennial cohort. So they're all coming into the market now looking to buy at a time where we've got an inventory shortage, and that's one of the reasons we're seeing such upward pressure on home prices.
Yeah, and I got to tell you, when we look at rates today, and again, pick a number, 3.7, 3.94%, wherever you are quoting rates today, and people say, well, that's still a great rate. Completely agree with you. Listen, I'm more years under my belt in this industry than I'm going to admit. Okay, but I do remember much more significantly higher interest rates. I was excited as a loan originator when they got under 10%. Okay, so yeah, I agree with you. The difference is, folks, is that you can't always just compare rate to rate, because the other side of that is home prices were a lot cheaper back then, right? So it's a little bit of a different effect. Now, incomes are higher too. So once again, lots of variables, but it isn't exactly an apples to apples comparison.
No, it's a good point. Boy, you bring back memories of last millennium for me, Barry. Gee, when I was a first-time home buyer, and that was last millennium, my very first mortgage, 30-year fixed rate, 10.5% contract interest rate. House prices, though, were a lot cheaper. It's true. But I've benefited from the decline in inflation and mortgage rates that Paul Volcker, helped to start back in the 1980s, wringing inflation out of the economy. And that's what's brought mortgage rates down. And I refinanced a bunch of times over the years.
I've learned so much during this session. I want to spend the next couple minutes here reviewing your guys' questions. So if you have questions, feel free to go ahead and put it in the chat box now. The first one that I want to read off is from Julia. Have we talked about institutional investors now buying single family homes and what that is going to do to supply pressure?
Hey, it's a great question. I'll give you my take on it. We have seen a pickup in institutional investors in the marketplace buying homes and putting them into the single family rental market. They're meeting a demand too. So rents, as I've mentioned, and as Barry's mentioned, rents are up 12% plus over the last 12 months. Partly it's because rental vacancy rates are so low. So we do need more rental inventory. And a really interesting side note with this pandemic is that there's been an increased pressure on single family rentals. That is more demand for single family rentals relative to high-rise apartment rentals. Because during the pandemic, a lot of families that rent needed more interior space because they were working from home or they needed the classroom from home. And they also wanted to have that social distancing with neighbors. And the average single family rental home has twice as much space, twice as much square foot of living area compared to a high-rise rental apartment. So in particular, over the last 2 years, a lot of demand, a lot of pressure in the single family rental market. And that's why vacancy rates are so low and rents are up so much. So we do need more inventory in the single family rental stock too. So they are providing that. Now I know that means they're buying more homes too, but in my mind, the market will equilibrate. It will adjust, and we'll see prices and rents, equilibrate over time.
And another question here that I do want to bring up, we kind of talked about it a lot. We talked about how we're short on supply due to all of these issues, labor issues, supply issues, all of that. We talked about when we feel like this will become kind of normal. But a question that I have is these microchips. I'm curious your thought on how long it's going to take to kind of even out this microchip shortage that we have, which is making it hard because they can't get in the appliances. They, can't put all the things in there that include building a home.
Yeah, microchips are, let's say, that's a big one. Semiconductors, a lot of them come out of Taiwan. The world needs them, so it's not just us. So there's a lot of competition for this. It's a tricky situation. Will it eventually work its way out? Probably. Probably during this year, we see a big alleviation, and that's what's really impacted the automobile marketplace. Many of us know how hard it is to get a new car. Many of us are shocked when we see we could probably sell our car for a lot more than we thought we could have based upon past experiences. So this is also, as you mentioned perfectly, Megan, it's in the housing market too. I think that this starts to alleviate itself during 2022, maybe not fully, but I know that the US also is trying to learn from this and build some plants to create more semiconductors here, so we're less dependent should, heaven forbid, another situation like this occur.
And I tell you, I agree completely. And chips are in everything. With the smart home. I mean, it's even in garage doors, and just turning on your light switch. You can do that all remotely with a smart home. So you got chips built into everything, even devices like that. So I think it's still going to take a few months. There's still a bunch of container ships stuck outside of Long Beach port, waiting to come in and get unloaded. So it's going to take a few months to really work through this.
And I have one more question, just because we've been talking about it in our morning update a lot, and I'm curious your take on this, is we've been talking about if Russia is going to invade Ukraine and what that could potentially do to the markets.
Wow. Yeah. A great question because of the seriousness of the nature and of the issue. And it's not good for the economy, and it's not good for the market. It's very disruptive, creates a lot of uncertainty because you don't know how it's going to play out. It could cause energy prices to spike. That adds to inflation. So if the Fed really is focused on inflation, they may have to take more aggressive action, which is not good. But it could also possibly, precipitate a recession. Well, okay, that's not good in terms of jobs, but that might be good in alleviating pressure on prices and inflation. It's very disruptive in the market. It's not good for the economy. I think it'll be a very, very challenging market.
So I agree. I think it would be awful. I think that we've seen already an increase in energy prices just because of the threat of that. We all know energy prices contributes to inflation, which would not be good for rates, wouldn't be good for housing. So the world's so interconnected. But then, you wonder if this is all about NATO. We've talked about it, as you mentioned, Megan, in the update. There's been a push to get Ukraine into NATO, which means an attack on Ukraine means an attack on all the NATO nations. God forbid that could be a world war situation, which would be another, not good thing. So Russia does not want Ukraine in NATO. So there's a big thought process that Russia is amassing these troops to pressure the request of having Ukraine and NATO be pushed back. And therefore it's okay, if you guarantee us that NATO's not going to, Ukraine's not going to be in NATO, we'll withdraw troops. These are things that it's a chess match with very, very, very high stakes, but there's also a lot of importance to what Ukraine has for the rest of the world. And I just want to tell you, so because it's so big, I'm just going to try and read to you a little bit of it. They're first in Europe with uranium reserves. They're second in Europe and 10th in the world with titanium ore reserves. They have the second most explored reserves of manganese and ores in the world. They have the second most reserves of iron in the world, second most reserves of mercury ore, third largest reserves of shale gas in Europe, 13th in the world. They have the seventh most reserves of coal. They have the most amount of arable land in Europe. They are first in the world in the number of sunflower and sunflower oil exports. They're the second largest producer in the world of barley. The list goes on and on and on and on. The point here is that it's not just, Russia and Ukraine. This has enormous implications for the rest of us, and prices of what we look. First of all, highest and most is safety and humanity, of course, but it's our job to break down what this means economically. It will have terrible implications for the rest of the world, for prices, for instability. So not a good situation. Let's hope it resolves peacefully.
Well, I want to thank each of you for your time, and I want to thank everyone for attending. We have a lot of wild cards this year, and we're just going to have to stay patient and see how it all plays out. I'm going to go ahead and post a link. This is to the CoreLogic blog, where you can find a lot of the content that Frank was talking about in our wrap-up email. I will also put a few other links that he sent over as well. And again, thank you guys for your time.
I want to say thank you to everyone who watched, but I also want to give a hat tip. Those statistics, that was something that was sent over by my dear friend, the always brilliant Peter Bookvar. So I just want to give him credit for that and say thank you to Peter for those great statistics. Frank, what a pleasure to see you. You're looking great. I appreciate your friendship always. I appreciate your brilliance and insights, and thank you for sharing them with us, Frank. We appreciate you so much.
Thanks, Barry. It's great to see you too. And thanks so much, Megan. Really enjoyed it today.
Thank you.
Bye, everyone.